I'm Santiago, CEO founder of Inversion, and you're watching Taking Stock.
Counting down to the close, everyone. It is Thursday, March 26th. This is Taking Stock. I'm Kristen Scholler. Down here on the floor of the New York Stock Exchange, we got a lot of news moving the markets today. What started as a relief rally is turning into a reality check. Confidence around a U.S.-Iran peace plan is fading, and markets are pulling back as mixed signals cloud the outlook here. The major indices all in the red, the S&P 500 leading the decline, and Brent crude back above $100 a barrel, reversing yesterday's drop. Now, while diplomacy drove the bounce, uncertainty is driving today's sell-off. Oil rising again and investors reassessing inflation risk and whether this conflict could start to weigh on growth. Now, on top of that, we got a lot more to cover here. Ted Rossman of Bankrate is going to join us shortly to discuss what it means for the consumer. We'll be talking more about that. Plus, we're going to get our queue all set here. We're also going to talk to AJ Warner of Offchain, breaking down Robinhood's new public testnet. And Pedro Palandrani of Global X ETF stopping by after ringing that closing bell to discuss the launch of NYSX. Scarlett Cedro joined us too. And we got more coverage from the Blockworks Digital Assets Summit. This is Taking Stock, and let's take a look at that closing bell. The trading day, Global X ETFs doing the honors, of course, ringing out the session here. We're going to be joined by Pedro Palandrani from Global X ETFs a little bit later in the show. Let's take a look at the tape. The S&P 500, I see down here on the trading floor, finishing the session down 1.7%. The Dow off 1%. The NYSE Composite lower by 1.3%. The small caps down 1.7% as well. Same loss as the S&P 500. Certainly investors taking risk off of the table here after what's been 4 straight weeks of losses. Joining me now to talk more about the consumer impact, what it means for you and your money, is Ted Rossman. He's senior industry analyst at Bankrate. Ted, great to see you down here on the floor of the New York Stock Exchange.
Hi, good to be here.
Look, there's a lot to talk about today, so let's start with where we finished on markets. The S&P closing down 1.7%. What does that mean?
Yeah, people are definitely nervous. I mean, really, it's the war in Iran that's driving everything these days, relating also to inflation, oil and gas prices. That's really one of the biggest drivers of not just the markets, but really how consumers are feeling. And we're seeing really a psychological impact when it comes to higher prices for filling our cars, but potentially other things too. I mean, transporting goods. This could really apply upward inflation pressure across our lives, which is obviously unwelcome.
Okay, so let's talk about where we stand right now when it comes to credit card debt. I know this is something that you follow very closely at Bankrate. What is the state of that?
It's really the proverbial tale of two cities. You know, on one hand, we have half of cardholders paying in full every month, getting rewards, really generally doing well with things. And then you have the other half carrying very expensive debt. Even though the average credit card rate has fallen a little bit, it's still close to 20%. And we do see some distress in terms of rising delinquencies and people really having difficult debt loads. The average is $6,700 according to TransUnion. So it really is that classic have and have not kind of situation. Overall, the credit card industry is doing well. I mean, these companies are making a lot of money on interest. Delinquencies have gone up, but not in a terribly worrisome sense. It's a little bit of a Goldilocks scenario for issuers, but for the borrower who's carrying interest at 20%, that's a tough spot to be in.
Look, let's talk about something positive here, and that's that tax refunds are expected to be bigger this year. I have nearly filed my taxes, so I'm hoping for a good refund as well. What's the best way to deploy that strategically in these times?
Paying off credit card debt is actually one of the things that should go towards the top of the list, because the average refund this year is about $3,600, and that's up about 10% from last year. This is the largest windfall many households will get all year. putting that towards your credit card debt. That right there knocks out more than half of the average debt load, or maybe using it for investing or boosting your emergency fund. These are all smart uses of that money.
Okay, so I see here that 29% of Americans have more debt than savings. What's behind that statistic?
A lot of that has to do with emergency expenses, so that's the number one cause of credit card debt. Medical bills, car repairs, home repairs, kind of the proverbial rainy day. Second most common reason is day-to-day expenses, just things like gas and groceries outpacing your paycheck. There's been a real cumulative effect of inflation and higher prices, especially on lower and middle income households.
Yeah, you know, it's interesting that the services inflation is making some of those surprise medical bills super sticky, as well as some of the other costs, Ted, that you just outlined there. So we finally have mortgage rates that were lower, now they're higher. It's hard to keep track. What does that mean for the average home buyer?
Well, that's another consequence of the war in Iran. That's the biggest reason why rates have jumped lately. We recently fell below 6% for the first time in 3.5 years, and now we're back to around 6.5. It's bad timing because spring is often the busiest home buying season of the year. I mean, honestly, it's not the best time to buy overall, but for the right, well-qualified borrower, if you're planning to stick around, some people talk about marry the house, date the rate. You could always refinance later on. If you have good credit, if you shop around, you can beat the national average. Maybe you can get 5.6, 5.7. Unfortunately, though, 6% is a psychological tipping point, and if we were to head noticeably below that, that could open up some activity. But unfortunately, we got that head fake where we got there and then we started to go the other way.
Yeah, I know. It's been interesting to watch that indeed. Finally, Ted, we have just about 45 seconds left for anyone who is facing a high credit card rate. What's the best way to manage that?
Get a 0% balance transfer card. Some of these deals last as long as 24 months. That is a tremendous tailwind for your debt payoff efforts. The US Bank Shield Visa is a good example. There are some other cards like the Wells Fargo Reflect, Citi Simplicity. They have 21-month terms. Avoid interest for as long as possible. 2 years, that's a really big tailwind.
Yeah, that is a pretty good deal. All right, Ted Rossman, he's a senior industry analyst at Bankrate. Ted, thanks so much.
Good to see you.
Yeah, great to see you. All right, everyone, let's take a walk. We're going to do a little walk and talk down here on the floor of the New York Stock Exchange, talk about some NYSE notables. These are stocks that are up on the day in the green. We got two big ones to cover, Best Buy and Cava. Just to name a few, we're going to show you their trading post here at the New York Stock Exchange and share more about why they are on the move. Best Buy, of course, here on the move because the electronics retailer, of course, reporting earnings. And it's a story about margin defense. We're going to get there eventually. Best Buy, we see right there, closing up about 4.5% on the session. Howie, our cameraman, is going to zoom in. So here's what you need to know about Best Buy. I mentioned it's a margin defense story. Profit beat, Q4 earnings topping expectations earlier this month as the company delivered stronger than expected bottom line results despite softer sales. High margin growth, advertising and third-party marketplace businesses helping offset weakness in core electronic sales. And a confidence signal, the company raising its dividend to 96 cents a share, showing management is still bullish on cash flow. Great, now Howie's taking a look at Cava. You know, that one was up on the session, but it looks like it's turned lower. I do want to note here, ticker symbol CAVA. This stock actually did get an analyst call that was pretty positive earlier in the session. Guggenheim initiating this stock as a buy with a $100 price target, so that's more than $20 above where it currently trades. Guggenheim giving it a projected 24% revenue growth through 2028. This call is certainly about execution, same-store sales accelerating about 5% and expansion into new markets like Ohio. The company with plans to reach 1,000 locations by 2032, investors treating Cava as a high growth opportunity in what has been, in some cases, a slower consumer environment. All right, everyone. Earlier this week, FinTech TV lead anchor Remy Blair sat down with Catherine Gu of Solana at the Blockworks Digital Asset Summit 2026 right here in New York to talk the Solana developer platform. Let's take a listen.
Welcome to FinTech TV. The Solana Foundation just announced the official launch of the Solana Developer Platform. The SDP is designed as a one-stop shop for enterprises and financial institutions to build and launch financial products on Solana, powered entirely by APIs. Now, global heavyweights like MasterCard, Western Union, and WorldPay are already on board as early users. Joining me here at Digital Asset Summit 2026 is Catherine Gu, Head of Product and Digital Assets at Solana Foundation. Catherine, great to have you here. Thank you so much for joining me.
Thank you so much for having me. It's great to be in person.
Well, of course, I do want to ask you about this announcement. So tell us about the SDP platform.
Super excited to get this thing coming to life. Took us about 3 months roughly to build the first version, and there's a lot more to come, by the way. But essentially, as we're thinking about the motivation behind SDP, is basically lots of financial institutions are very crypto curious, and they really want to start testing and iterating on ideas. Now, the problem is, like typically, it will take them a very long kind of life cycle for them to even start building anything on chain because of, say, technical understanding, and there's a lot of bottlenecks in terms of like navigating different solution set. So, in order to abstract away a lot of the infrastructure and background complexity, if you will, we created this one single platform that aggregates the best of Solana all into here. So what that means is basically we have 20 plus different infra providers that make SDP alive. So, you know, whether that's coming from the wallet side custody or whether that's coming from rent side or compliance, we have the underlying infrastructure partners to actually power these services behind the hood. And also we're showcasing some of the best features on Solana, whether that's, say, gas list, sponsorship, or whether that's, say, to do with token extension that says you can issue a stablecoin with certain permissioning features embedded and you can customize that. It's all wrapped around in different forms of API. So then as an enterprise developer, API is a very familiar playground for them, and we make it as seamless as possible for them to start building cycle that idea much, much faster than what they typically would experience.
And amongst some of the early adopters, here are some heavyweights have been named. So tell us what they're building and also what their primary use cases.
Yeah, so, you know, very proud to have 3 major sort of payment companies joining us here. I think it's actually quite spread out in terms of the use cases they're looking at. So starting with MasterCard, they're looking at stablecoin settlement as a natural place to begin. So what that means is really between MasterCard and the issuer and the acquirers, they will now want to start experimenting directly settling at the end of the day the obligations with one another in stablecoins as opposed to convert it back to fiat. So for them, they want to test to facilitate the stablecoin settlement directly on Solana through SDP. Now, if you move on to someone like WorldPay, as they're looking at from their acquirer angle, they're more looking at merchant experience related type of use cases. So that would be like if merchant want to be paid directly in stablecoins and using Solana as the underlying blockchain infrastructure, how do I conduct that? And what kind of wallet infrastructure I need to create for my merchant customers for them to use? So that's WorldPay. And lastly, on Western Union, the huge global remittance provider, they're already actually experimenting on Solana, as you know, with the launch of their own stablecoin. But specifically, as we're looking at the collaboration between Western Union and Solana, it's a two-way approach. So on the one hand, they want to be a user and leveraging SDP to facilitate a lot of the cross-border flows. On the other hand, they actually have a new product as well. It's called DAN. It's Digital Asset Network. So through this relationship, we are actually partnering with them, and Western Union become a infra provider as well. Through this digital asset network, they can allow any customers to have the experience of cash out in fiat. And that's really powerful in the sense we have all these crypto custody infrastructures on SDP. You as a user, you can trade and do whatever you want with crypto assets. At some point, maybe you want to off-ramp it and cash out, right? And this is where DAN from the Western Union kicks in because they create that last mile delivery to cash out in fiat.
Well, Catherine, it was great having you join me as DAS 2026 gets underway. So thank you so much for sharing the latest regarding SDP.
Yeah, thank you so much for having me on the show.
Thank you.
And welcome back to Taking Stock, everyone. We're live down here on the floor of the New York Stock Exchange. Joining me now at the FinTech set is AJ Warner, Chief Strategy Officer at Off Chain Labs. AJ, welcome.
Thank you so much for having me.
Yeah, we're happy to have you. Now, Robinhood just launched its public testnet for Robinhood Chain on Arbitrum with massive partners, of course, like Chainlink and Alchemy. Of course, you're playing a role in this as well. What more can you share?
Yeah, it's a very exciting moment. So I work at Off-Chain Labs. Our product that we build is something called Arbitrum. It's the leading scaling technology for people that are looking for execution environments to build on top of blockchain technology to power their business. We have a partnership with Robinhood where we're building for them their infrastructure. Right now, they're living on the current public Arbitrum chain. We have about $20 billion in assets that live on the chain that are powered, doing billions of dollars of economic activity. Robinhood decided the next phase of what they're trying to do in a deeper partnership with us is use our technology to build their own chain, a chain designed for stock tokenization, the tokenization of other assets that they can bring to their users. And it's a really exciting moment, so we're the infrastructure running all of that for them.
I want to dig into that a little bit more. What does this tell us about institutional blockchain infrastructure?
Yeah, so we're like 4 or 5 years ago, you had a lot of people using blockchain. It was much smaller organizations, startups, DeFi protocols. Every day, more and more institutions, fintechs, financial firms are coming on chain, using their assets, looking at tokenization, stablecoins, how can that improve their businesses? And it's been a true clear watershed moment. Robinhood, I think, has been at the forefront of this. Even last year, they launched the tokenized stocks throughout Europe. So if you're buying a stock token, if you want exposure to Tesla through the Robinhood app in Europe, you're really buying a token underneath the hood on Arbitrum. It looks and feels exactly like the regular Robinhood app in America, but it's blockchain technology that's powering that global expansion for them.
How is the user going to notice the difference in this, the change that this is bringing?
So the nice thing is that the user should not feel the difference about whether something is a brokerage issued asset like it is in the United States or if it's a token. The thing that tokenization allows is it allows, first of all, the business to grow more quickly, which is better for the business. It gives more access to retail in different parts of the world where it might be harder for them to access US equities. But the other thing that it enables is more utility for these assets. The ability to seamlessly pledge these assets as collateral. That's something that's available maybe to accredited investors today, more sophisticated financial actors. But for the average retail person, if they want to borrow against their Tesla stock or their Nvidia stock, it's not something that's seamless and easy. And tokenization makes it much easier for these assets to be enabled into DeFi protocols to borrow against.
And in terms of the doors that this can unlock for 24/7 trading, digital trading, instant settlement, what more can you share?
Yeah, I mean, that's a huge component of this. You don't have to deal with T+1. Everything's happening at the finality of the blockchain, milliseconds at best, and it's really a powerful user experience. So if you think about opening leverage positions, the ability to access your liquidity immediately upon opening or closing a position, blockchain technology enables all of this through the mechanisms designed in the underlying technology. And when you look at Robinhood, and we work really closely with them, their goal is to rebuild the fabric of the company on blockchain rails. It allows more access, it allows for more inclusion, it allows for more efficiency, and it also improves their business margins in a way that's really impactful to the underlying bottom line.
In just a few seconds, AJ, anything more our viewers should know about Arbitrum?
Yeah, so Arbitrum was technology that was founded in Princeton in 2018. It's the leading technology that's scaling Ethereum. There's millions of transactions occurring a day, billions of dollars of assets flowing through Arbitrum. We've got hundreds of different financial institutions and enterprises that are using the technology in a customized form, like what Robinhood wants to do with the Robinhood chain, to ensure and enable that they can build environments using blockchain technology that work for their needs. So in the early days, a lot more people were using the public Arbitrum chain, and today we're seeing a lot of financial institutions want to build their own versions of this technology using our stack, add compliance layers, privacy layers, whatever the business use cases and needs are for what they're trying to accomplish. We have the flexibility of the technology secured by Ethereum, using Arbitrum to build what we call the programmable economy. We think all of these assets should be using shared liquidity, composability for more efficiency for users, and more access and availability.
AJ Warner, Chief Strategy Officer at Off-Chain Labs. AJ, thank you.
Thank you so much for having me.
All right, everyone, we're going to take a quick break, but stay with us. Welcome back to Taking Stock, everyone. We're live down here on the floor of the New York Stock Exchange. You saw the closing bell earlier this hour. Global X ETFs celebrating the market finish. And I'm joined now by Pedro Palandrani, Head of Product Research and Development at Global X ETFs. Pedro, welcome.
Thanks for having me.
Yeah, we saw you on that closing bell podium. Great job up there, of course. Global X ETFs launching the NYSX fund today. Why now?
Very exciting. Today we're launching NYSX, as you mentioned, really trying to tap into the top 100 tech and tech-enabled growth companies, and we believe that there's no better time for investors to really try to get targeted exposure to innovation. We feel that there was a missing gap in the marketplace, and we're offering that with an NYSX ETF.
You know, we talk about innovation all the time down here on the floor of the New York Stock Exchange. This follows the NYSE 100 index, is that right?
Yes, and great partnership with the New York Stock Exchange and ICE to bring this ETF to market. Again, investors are looking for targeted exposure to innovation. There's no better way to tap into that than with NYSX, right? There was a missing gap, I mentioned before. Investors were either gravitating towards tech as a sector to capture that innovation. But as we all know, innovation is not happening just in the tech sector. Just look at the Magnificent Seven companies. A lot of them are outside of the tech sector, whether that's consumer discretionary, communication services. So this ETF is really tapping into multi-sector exposure, but again, also across all major US exchanges in the United States.
Give us a sense of some of the biggest names in this ETF.
Look, you're going to see familiar names like, again, many of the Magnificent Seven companies, Amazon, Google, and whatnot. But again, you're also going to see companies like Oracle, TSMC, Palantir, names that you perhaps are not going to see in major benchmarks. Again, really tapping into the tech sector, but also outside of the tech sector, communications, consumer discretionary, and many other sectors where we see growth opportunities ahead.
And what is your view on the future of this fund long term?
Look, this is going to be a benchmark for investors that are seeking innovation exposure. Like I said before, investors have been either gravitating towards tech sector, but there are challenges just by looking at tech and trying to capture innovation, or have been gravitating towards other benchmarks to get that innovation exposure, but perhaps those benchmarks are tapping into just one exchange or are tapping into just one specific area of the market. So this is going to bring to market really innovation exposure for investors out there.
Yeah, you know, it's interesting. Obviously, we see a volatile market right now, but it does have some market participants commenting publicly that it is an opportunity to buy the dip on these technology names. What are you watching when it comes to the market environment?
Look, there's a lot of volatility, there are a lot of news, of course, but like you said, I think there's no better opportunity for investors to tap into long-term investment opportunities, and I think this is what this type of ETF can give investors exposure to, right? Again, we're seeing so many structural and secular trends in the marketplace, whether that's artificial intelligence, defense technology, streaming platforms and whatnot, and this is a way for investors to capture long-term investment opportunities despite of the volatility.
All right, Pedro Palandrani. He is Head of Product Research and Development at Global X ETFs. You saw him on the closing bell podium. Pedro, thank you.
Thank you for having me.
Yeah, great to have you. All right, everyone, stay with us. We'll have more from the NYSE on the other side of this break. All right, everyone, time now for a few fintech, crypto, and AI headlines. First up, the crypto majors of Bitcoin, Ethereum, Solana down several percentage points on the day in a risk-off return, of course, spurred by rising doubts over Trump's Iran peace plan. But next up, the New York Stock Exchange partnering with Securitize to build a platform for tokenized securities, allowing equities to trade as digital tokens with 24/7 access and instant settlement on the blockchain. Finally here, chip stocks under pressure after Google unveiled the new AI memory efficiency breakthrough, raising concerns that future demand for high-end memory could soften. All right, Money 2020, Scarlett Sieber is back to explain how fintech companies really make money, and let's take a look.
Welcome back. I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make that money. The show that breaks down the infrastructure you never see but absolutely rely on. Today we're going to be talking about TransFi, the stablecoin payments network quietly fixing cross-border transfers while everyone else is still waiting for their wire. TransFi builds global payments infrastructure on stablecoin rails, especially in emerging markets where traditional banking networks underperform. So how does TransFi actually make money? First, transaction fees on cross-border domestic transfers. Second, FX and spread revenue on conversions between stablecoins and local currencies. Third, API and platform fees for enterprise partners. And fourth, on-off ramp fees for fiat to stablecoin conversion. So let's do a momentum check real quick. TransFi just raised $19 million to expand its stablecoin payments network, validating the massive demand for cheaper and faster cross-border rails. So where is their moat exactly? It's all about the geography, baby. Transfer builds rails in markets most big players overlook, where the pain is the highest and the opportunity, it is enormous. So that is how TransFi actually makes money, by becoming the fast lane for global payments in markets everyone else maybe is overlooking. With that, back over.
All right, everyone, thank you so much for watching the show. That's just going to about do it for us today down here on the floor of the NYSE. We do see losses across the board, but tomorrow's another day. We'll see how stocks finish the week. You do want to tune into our morning show, NYSE Live at 9 a.m. Eastern. I'll be counting you down to the open and breaking down all of those overnight headlines because we know it's a headline-driven market. That's just going to about do it for the show today. Thank you, as always, for watching. We'll have a lot more tomorrow. Ashley Mastronardi will be hosting the afternoon show, and that's going to do it. We'll sign you off. Thanks again.